This is Justin Pulitzer. This is my weekend review video for Sunday, April 17th, 2016. Good amount of stuff to cover. We're going to start off as usual with the 6 market keys, flow into the 7 Fed keys, and then talk some indices and then some individual stocks. So let's start out with the VIX. Why not? So I created a VIX key. This is how I see the premiums at the moment. This will be subject to revisions if I see any changes, but at the moment I believe that these are correct. You can see that we had been in a period of fairly benign volatility with a couple of little spikes. The spikes started to get a little bit more dramatic, culminating in the flash crash. And then since then, we had been potentially transitioning from a period of low volatility seen here to maybe one of higher volatility seen here. However, this violation of the channel and the subsequent failures to break back into it, and there have now been many, you have 1, 2, 3, basically 4, doesn't bode well for the bear market thesis. Although I will say this, that the VIX does have some intrinsic value, meaning at some point people do buy protection, and we are getting toward the lower end of that area, and it's starting to look to me like there could be, some risks to a pop in the VIX. If there were to be some kind of spike down into here, it would be a good opportunity, I believe, to buy some directional shorts in some of the major market indices like the SPY and the IWM. That being said, we are looking more and more like we are in a period of more benign volatility at the moment. So until we can start crossing up above the 1785 level, which now you have a declining 50-day moving average, and then the 200 is a little bit above there, with the 100 being still above there. I think as long as you're contained below these major market indices, these major moving averages, you can see here they were support. Now I would think they would be resistance. That's the VIX. The dollar. I have discussed this being in a trading range. We had this massive run-up and then this kind of leveling off. Moves below the lower end of the range have been unsustainable, quickly unsustainable, as you can see again here happening. Moves above the top of the range have been unsustainable as well, but stubbornly more sticky. You can see the dollar is kind of bombed out here. It's starting to have a bit of the stochastics are starting to turn back up. You can see we're making lower highs, which is good, and lower lows, which is good. However, we've now made a pop. We had a look below range for a few days, move back up, and now that has held. So as long as the dollar is sort of in this lower end of the range, there's risk for things like pullbacks in oil or gold or whatever commodity related, or even the stock market, as the dollar starts to rise. I wouldn't get too crazy. As long as you're seeing lower highs and lower lows, it is good. Maybe eventually this range will really fall out of bed, but until then, I will stick to my story with regard to being long the dollar when you get below the lower support. And you want to start shorting it or flattening when you get to the upper part. That does, however, lead me to... I'm going to do treasuries. No, I'm going to do oil first. I usually do the treasuries first, but let's just do the CL. All right, so I've been in the camp that says oil is trying to bottom. You can see we are making higher lows, and here equal highs, but starting to make some higher highs. This to me is starting to look maybe like a potential inverse head and shoulders. I don't know that that's going to be the case, and there is plenty of room for further pullback, even to a 50-day moving average or one of these Fibonacci levels. We're kind of double topping here, and we're a little bit of a long way from Kansas, if you will, meaning the 50% and the 61.8 fibs are quite dramatically lower. However, we had run up here. There was some expectations of this Sunday meeting with Saudi Arabia and Russia, and I think that there was a little bit of optimism, but I'll tell you, most of my interactions and reads on the stream were people pessimistic. I know all the TV reporters are very pessimistic, and I honestly wasn't really expecting all that much out of the Doha meeting with OPEC. but I do think it could provide an opportunity for a pullback in oil that could be buyable. You can see that there's a trend channel a little bit lower here. You could also see here there's a volume distribution, and look, you had this gap down. We basically are holding the 20-day moving average and this distribution. So, I wouldn't get. I think a lot of people went in short into the weekend with oil. So we're gonna have to see how this trades regular trading hours. Below 39 could get a little bit slippery, maybe down into the 37s. And if this fails, for example, if we could get back up above $40, I think you could see a bit of a squeeze. Honestly, I know a lot of people are probably excited about this here, but I just traded the ranges, and you have a defined range here on this gap bar. So that's how I will be playing oil. More so, importantly, than playing the commodity directly, I like playing the stocks. And we have something here. Look at this. You had a very long decline in XLE. And you had a bit of I'm loath to say, I guess you could say a professional gap, because it did go. So look, you had this gap here, spent a couple of days building pressure below the trend line. This big dramatic breakout candle, which basically got us up to the 200-day moving average, which was the first time, long time, so long that it isn't even on this chart. I'm trying to, let's see. This was the last time back here in September that we were even, 2 years ago, that we were even close to the 200-day moving average. And for the first time, we had challenged it and actually broke above it. So what am I looking for here with the XLE? I would love to see a pullback, believe it or not, to the 50-day moving average and the trend line, and I would consider that buyable, particularly if it coincides with this low here, this 59.94. So if there is still pullback to that level, I would be a right or right out buyer. It's possible that it pulls back a little bit more into the 58s. You can see you have a reference low here, and this was really the breakout of this range, like the 58s, high 58s. So somewhere in here, I'll be looking to sell some probably out of the money puts. I don't necessarily know if we even fully get that. I like this candle here. This was the big, the definitive breakout candle. So I'll say this: anything above 64.33 is a long. Anything below 62.22 is probably either a right or right out short or a GTFO, meaning get the F out. Often you'll see a breakout and then a retest of the backside of that trend line. So I'm going to be kind of looking for either the backside of that trend line for a long or for a test of the primary trend. For me, the story with oil is I believe it's bottoming or has bottomed, and it's making higher lows and higher highs. I like to play in the main trend, so I'm basically looking for pullbacks. The other one, my favorite of the lot, is this Exxon. We've discussed the virtues of 83.01. Anything above there, and anything particularly above 84.70 is more bullish. You can see we're kind of forming a bit of an up pattern. I think Exxon wants to go higher. You sort of have an up pattern within a larger up pattern. 50-day, to me, is important. You can see once you broke above that here is really when things ran. So pullbacks to the 50, I believe, are buyable. The bonds. All right, so a lot of people don't really understand finance or do a good impression of people who don't understand finance, but bonds are important. Why? All right, so we all know about bond equivalent yields. Maybe we don't. That's why you have stocks like Coca-Cola trading at 23 and 26 times earnings. Flash to that quickly. You can see Coke basically got close to the all-time high here. The channel high. I still think that there's potential to see the 1.618 fib extension up at $50. I don't know how long it takes to get there. We may have to come back and retest 45s in the 50 MA first, but I do think that we could see higher. So why is Coke trading so expensively? 23, 26, however you want to measure it, times earnings. The answer is that bonds are trading historically expensive. So What is the risk? The risk, of course, is interest rates rising and there being some type of a bond collapse. But we know from the Fed that they see the risks to inflation being neutral to down, and they aren't in any hurry to normalize. And even when they normalize, they're still going to be holding assets on the balance sheet. So they basically have said that they are going to kind of defend against some type of really nasty move down in bonds. I mean, you could see pullbacks. There have been some nasty periods here, but this is still all within the context of being relatively high. So stocks are valued on what's known as a discounted cash flow model. There's some other ways of doing it. You could do it based on dividend models, but the real accepted one, the one that Bloomberg terminals galore work off of, is discounted cash flows. And one of the components of the discount rate, hurdle rate, however you want to say it, the correct discount factor is what's known as the weighted average cost of capital, also known as WACC. If you want to do a little Google work, I have to do a dedicated video on this one day. It's a little complicated and can take a little bit of a long time. But I will have to do one that's going to be, do it the right way at some point one of these days. I've just been a little bit busy. But basically, this risk-free rate here, the higher bonds go, the lower that rate goes. So I always just use a simple division example. There you have a numerator, which is the top number, a denominator, which is your lower number, and your end product, which is the total. So think about the DCF model, your denominator, the lower the dividing number. The lower interest rates are, the lower that number is, and the higher the end product is, which is your stock price. So if rates don't even need to really fall that much, you don't even need bonds to rally that much. If you just keep them kind of sideways or elevated, you get a premium multiple on the stock market. So everyone says, oh, growth is so crappy, we have 0.4%, expectations out of GDP from the Atlanta Fed. We all know the jobs numbers. I've been saying, we're a nation of waiters, waitresses, bartenders, and carnival ride operators. Everyone thinks I'm joking around about that, but it's actually a line item. And we know that the quality of jobs is very poor. So how are stocks this high? The answer is the bonds. The reason why is you have historically low interest rates, and that commands a PE, meaning a price to earnings multiple premium from stocks. So, if you say stocks are trading at 17 times earnings, that when stocks tend to get unsustainably strong when they're anywhere between, over 20 times earnings, and unsustainably low when they are below 10 times earnings. A lot of people have said that 15 times earnings is the regular market multiple. It's not really true. Believe it or not, the market spends very little time at that level. It usually is vacillating from one extreme to the next, but between 20 and 10 is 15, so I guess people, it's an easy way to think about stocks. But I will assure you, as long as the market, at least the bond market, stays with historically low interest rates, stocks do, even in a low-growth environment, deserve to trade at a premium multiple. We know from the Fed they're willing to accept some amount of inflation. They've talked about this gradual pace of gradualism. I mean, these guys are just basically dancing around what I've dubbed lower for longer and maybe lower for life. I don't know, but at least for the next 2 years, they don't see themselves reaching the 2% inflation target, so we should theoretically have low interest rates for a while, which could keep the stock market at a premium multiple for longer than people expect. It's at least in where I went to school at Stern Business, they taught us that the average market return is 10%. In 2013, the market went up 30%. Let me pull that up. You had this, let me go a little longer out. You had this amazing move up in stocks. For the next 3 years, next two and a half years, we have been basically going sideways, working off some of that excess. So you basically had 3 years worth of gains in 1 year, and we've spent the last better part of 3 years working off the balance. So I think a lot of people are mistaken this. I mean, this could be a transition. I've talked about this potentially being a big rounded top. The only problem I see with that issue is how far we've come back up. But I want to hold this off for a minute and finish up with the market keys before we get into the S&P. So that's all you need to know with regard to treasuries. I'll say here, as long as we're basically trading above the 20 and 50-day moving averages and even the 100 to some degree, you got to factor in the fact that that stocks are probably going to stay a little bit stronger for longer. How do you like that? Then that's a new hashtag, stronger for longer. Just invented that on the fly here. Then people may think possible and maybe even see as reasonable. The China situation. So China is looking a hell of a lot better. Take a look at this, for example, 10 years weekly. Look where this held. We basically had a bit of a look below and fail here. We held this a key low. And I've said for a while, when you break down from a old trend line, you tend to want to retest it. And you kind of have the big volume nodes coming up here into like the 36s and 37s. So there could be still a little bit more to go. There's a little bit more to go to fill this gap here to like the 35s. It might overshoot a little bit. You have a descending 50-day moving average. Could be the case that we see a little bit more in China. I like the idea here that we're making higher highs and higher lows. You have a 50-day that has bent back up. You have a 20-day that is bent back up, and 100, which is kind of coming back up. This is the area I would think that we would maybe have some resistance at. There's a lot of high volume node there. You have a 200 MA and the backside of the old uptrend line. So China looking a bit better, but not really, I think it just got a little bit oversold. And it would help if I could draw trend lines properly, and not even to draw channels, but to draw a trend. Let's not even get ahead of ourselves. Let's try and draw a trend, nonetheless, the channel. So yeah, I mean, this is one way you can draw it. So I think that pullbacks in China could be viable as long as we hold trend. Righty. IBB, which is another proxy for risk on, is starting to look a little bit better. We all know the political issues that we've had here with Bernie Sanders, Hillary Clinton, Donald Trump, everyone basically whipping these guys. I do think that we could be in a situation where we've seen peak earnings. These stocks have been kind of grim death for a while, at least IBB. You could come down lower to complete the pattern. I've been talking about that. But I will say this, it might not be the case. We could have maybe bottomed here. Look where these, near where these reference lows are. You have basically a double bottom with a slightly higher low. Let me bring this into some more modern times. You've broken out over the 271.55 to 275.40 and just been consolidating. You retested here, held slightly lower high, but hammers. So I'm willing to say this: if you want to be long these biotech stocks, let's keep it simple, right? I mean, we have potentially a new trend in place. We'll see. It's a young one, and it's here a little bit steep. But I would say as long as IBB is over 275.40 to 271.44, you could even use this reference low if you want to give it a little bit more wiggle room, the 270.19, this swing low, which is really how I like to play it. I think that the trade is probably long here. So I like it long versus that low. I've been playing it with this ALKS. I talked about buying it a while back. You've broken trend. We're getting close to the gap. So this has moved a lot. I think that it just seems like, look at this, all this like attempts of weakness have been bought up. I think that this could eventually fill the gap. You have a 61.8. Keep in mind, this basically collapsed from an all-time high, and it was quite dramatic. So it wouldn't surprise me to see the gap fill back up to the 61.8 fib. That's also the high volume node here. But I don't think it's going to happen kind of so easily. I think that there could be a look into the gap, and then it's going to pull back, provide an opportunity to get long again, and then go. Listen, there's really very little here in terms of volume to hold it, so this could just go into the gap and just keep on running. I just don't think that that's going to be the case after moving from 27s up to 40 and probably into like possibly even 47s. I mean, who knows, I do think, though, that we are going to look over the gap, kind of reject initially. The question then is going to be, is the pullback dramatic to retest into the lows, to retest halfway into range? I would love a 50 MA test into these 33s. Or is it going to just be like kind of that, shallow, or go into the gap, go sideways, and then go? So there's a few different ways this can go. I'll be looking to book some profits on the first move into the gap. If there's some type of a pullback that's shallow, I'll be reloading. But that is, like I said, this has sort of moved a lot already. So I don't think that the first move into the gap is going to be the one that takes it. I think it'll probably find some sellers initially and then pull back, go sideways a little, maybe correct a little bit more, and then it'll set up again for a reload. Gold. Not one I talk about very often, but I feel like I feel the bound duty here to talk about gold. It's been getting so much attention. So let's talk about gold, baby. We have a trend break. We still have a lot of room to the primary downtrend line. Gold, though, however, doesn't always like to make it so easy. Take a look here. It's kind of peaking, pulling back a bit. I showed you where the dollar was in the range. It might get a little bit soft if the dollar starts to get some mojo. So I'm thinking we could maybe pull back to retest these hammers here, maybe in like the 109s, 110. There's a 50 MA roughly around here. Gold loves 61.8 fibs. A lot of you probably haven't been trading gold that long, so you don't know that, but gold loves the 61.8. I would be an interested right or right out buyer at the 61.8 or put seller. If you want to play it for the move down, play some put ratios, buy some puts and then sell 2 times out of the money. I don't know that that's going to happen here. Gold looks like it does want to go a little bit higher. I do think it's gotten quite extended and chased. You have it roughly holding the 50-day moving average. You've had several moves there. So as long as you're holding the 50, I guess the play is long. However, I wouldn't be such a chaser here. I would prefer the pullback to buy. So that's my take on gold. Let's talk about the Fed keys here. All right. So the jobs numbers are not great. I briefly touched on that. I don't want to go over that again. The Atlanta Fed, we know that everyone got excited that the fourth quarter was a little bit better. It was like 1.4% as opposed to 1%. So it was better than expected, but still below 2%. First quarter, the Fed now has lowered their estimate to 0.4. So we're basically at stall speed growth. I just don't see the Fed being so excited. We had a couple of ISM numbers that came out a little bit better. I think the good news is you had like 7 readings or so in a row that had been negative, and these were the first ones in both manufacturing and service that were non-recessionary. So I guess it's good that kind of pattern is broken. I guess not everything, things don't go down in a complete straight line. They weren't that great, but they were good enough to kind of say, okay, maybe we don't have a first half of the year recession. It doesn't mean we don't have a second half of the year recession, but these might be good enough that we don't. And I think that's why the markets have been rallying. Durable goods have not been that great. We all know my theory about peak autos and peak aero. The manufacturing numbers the other day were pretty egregious. We all know that we don't produce very much here. It's really becoming quite a weak, service economy. Consumer sentiment numbers weren't that great, so I guess people aren't, I told you that we had a bit of a bump in the durable goods recently, which has kind of been a pop and flop. People came out and they, I guess after 10 straight months of not doing much, they bought a couple of toasters, and washing machines. So a lot of that, in my view, is that. I want to address the housing market a little bit. So we've had this major run-up, and particularly in New York, there's this project that gets cited over and over again. It's 157th Street, and it's a very expensive building, and a lot of the 57th Street corridor in Manhattan has been Russian and Chinese money, and as the dollar has gotten stronger, as you've had a stronger dollar, it has, like we know, it's pulled back, but you had a big move up, and I think a lot of those people who were buying and counting on their currencies having a huge premium, in some instances 30% or more, they were getting real estate here on the cheap. I think that they were looking at apartments as safe deposit boxes with windows for the most part. And that has kind of calmed down a lot. There's also been some capital restraints put in by less than democratic governments. So I just think that this run up here kind of finally the brakes were tapped a bit. You can see we had a regression line here, and moves to the back side of it have been the kind of the buy. This is the real kind of sideways regression line. So we are well below there. There's room for the dollar to still rally. Anyway, like I was saying, so people were paying premiums in New York, for example, for these apartments. And as the dollar has strengthened, I think that the people who were getting, the discounts in their currencies are loath to pay the kind of premiums they were paying in the past. So the market is just cooling off a little bit. It's a little early to call a bear market or a recession in real estate, but, things don't always go up in a straight line. It always starts within the rate of change, and the pace of appreciation, price appreciation, is slowing, and even in some cases starting to pull back. So it could be the early signs of pullbacks in those markets. So that's the Fed keys. There's also the high yield. We know that the Fed has talked about the premium of high yield. This move off the lows has taken a lot of pressure off the Fed. They're not quite out of the woods yet, but this pattern is looking better. I mean, as this rallies, I guess the fear of global contagion, the tides of fear on that recede a little bit. So just keep that in mind. If this starts getting fugly again, people are going to start up with the global crisis fears. I think a lot of this actually has had to do with oil, the rally in oil, the fear that a lot of these companies that we thought were going to be going into bankruptcy are not. I talked about the XLE. I also think that this, believe it or not, is benefiting European banks. I was actually a buyer of Deutsche Bank and Credit Suisse down here on this trend line break. I wound up being like a day early, but these to me could be professional gaps. I mean, look at this. You have basically, I talked in last weekend's video that I said I would, everyone was assuming that we were coming down and that we were going to lose these lows. I said we have to assume they hold. They did, and you have these gaps. So I have long stock from down here that I'm going to hold on for a little bit. I have it in both Deutsche Bank and in Credit Suisse. Actually, I got long this right around before the Doha talks. We'll see how this trades this week. I mean, this could come right back down, but I have good trade location on the trend line break. So I'm going to try and hold it for a little bit. I don't necessarily think that these are going back up to all-time highs, but hey, if I could catch, 10 points in this thing, or, even $5, it would be nice. When you buy low, you get in pretty, decently. I think JP Morgan earnings had helped this. By Friday, they were looking to book some profits. You were also up to a 200-day moving average. I will say this with regard to JPM. He had the diamond bottom here. You just draw basically a trend line. We have new highs here, so you take the last low. Higher lows and higher highs. 200-day moving average is the sticking point. You basically have double tops here at 62.90, 62.91. Anything above there, I think she can fly up to 66s, which is midway in this consolidation range. Anything below there, maybe there is a bit of a pullback, into somewhere into the middle of this range, which would be a gap fill, which I do think is playable and could be a buy. The good news is that the pullback into the earnings day range, you are basically still above the earnings day close. So anything above 61.97, I would say, is still a buy. Let's use this day's range here as the key. Anything above 62.90, 62.91, which is these double tops, I think still has further to go to the gap fill. Anything below the 2-day low into this range, to me, would be just to sit on hands, or I wouldn't say it's a short, but I would say you probably don't want to be as long, because you could even play it as a short for right or right out against midway into this range. You could even use this high of day here as your stop, the 62.16. So anything below the 2-day range, it could be play with short with a 62, 16 plus close stop, or if you're, you could just do it intraday. Now let's get into it. The S&P 500. The S&P 500, yo. All right. Listen, I'm trying to make it interesting, right? All these technicians, I mean, they're really not that special. Everyone assumed everything was going to go to hell here. Look what this is starting to look like. This is starting to me to look like a big W pattern. And look, you had the breakdown, you had the lower high, the still lower high, you had the multiple bangs on these lows. This should have given out if the market was going to be super bearish. It did not. You basically undercut the flash crash low twice and still were able to rally, and now you're back up here. You really shouldn't be. I have some levels here, some proprietary levels that are important. You have a primary trend line that we're coming into. You have a high volume area. I think a lot of this consolidation here should have been up here, but it happened below here. You have 10 days of consolidation, and you have breakaway value and holding above there. That is bullish price action. This area here might not be the short that everyone thinks it is, although there could be some type of pullback. I think that we have oil down and the futures are down a little bit, although that doesn't necessarily mean anything for the opening bell. It just means that overnight inventory could be heavily net short and it get bought up by the open. We'll see what happens. This is a mechanical right or right out short. You can try it. But the fact that we've spent so much time right under the trend line, I think we'll have at least a look above trend. It may be a fail, but I think we'll at least look above trend and get everyone, all excited and longed up. And we could see the 210s. The expected move in SPY this week isn't all that exciting. That's because IV is so low. It's only $2.73. So to the up move, that would probably mean 210.51. So maybe somewhere between 210 to 11. The down move would be 205.05. I think as long as we're above this, like the Yellen day high here, the 205.23, any pullbacks are kind of like okay. You saw the broke out of range. It often happens where you pull back mid-range after a look above, and we're coming into this area, so it wouldn't surprise me to see the 205s. That would not be super bearish in my view. It would be actually fairly healthy. If it holds there and that's it, and it's a 20-day moving average touch, and then it goes back up, and you take these highs out, forget about it. You're probably going to see a retest of the old all-time high and maybe even a blow-off. I don't necessarily think that this... Look, you had your opportunity here. I talked about this. This is like the same type of price action here. It's a very uncertain market. You had this breakout 2 days here, retest here of the 204.12. Came back up. This day should have been consolidation. This was a bit of a fake out, a move down. 100% basic retracement back up. Days that opened strong and spent the entire day selling off here on positive breath, though. All of this was just people assuming that this was going to give. You had so many tests of this 204 here. The market was going to fall apart. It really should have done so here. Big push up here, gap and go. Strong consolidation. As long as you're above, in my view, this 206.76, I think that you have to consider the market is bullish. I think pullbacks to anywhere between 205.23 to 206.76 are still quote-unquote healthy. I think it's like okay. A few things that are disturbing me have been some of the washdowns in stocks, like you've seen some of the shenanigans being pulled in like Facebook and Apple that I will address in a moment. IWM, I talked about right or right out short situation, although the way that this is handling here, you might see a gap and go. I'll tell you. The way you get there is important. Look at this. You spent the consolidation, and now you're kind of hanging out up here. Anything above this 3-day high is, I think, going to be along to the 115s where there is more heavy volume. If you have a gap down and go on Monday, it could be a fail here. If you lose these 2-day lows, I think you can play right or right out short for a pullback, maybe to the lower part of this candle. We'll see. I don't think that this price action is particularly bearish, though. You basically are spending a lot of time hovering under this 200-day moving average. Any move over trend and these 2-day high and the 200 and the trend line is going to get a real nice squeeze going. That being said, we did get the gap fill. We did reach target. This is the spot to take profits. And if you want to test right or right out shorts, that's simple. I don't really like the short trade here, though, just because we spent a couple of days consolidating. This is a big body move up, small body consolidations. That to me is still bullish price action. So at the very least, book some profits. And if you lose the 2-day low here, then I think you could play right or right out short with a stop over the 2-day high. Keep it simple, stupid, right? Qs. All right, so we're basically futzing around near the gap fill in the 78.6. You're getting we're obviously a little bit overbought. The gap, we're not really that much higher over the consolidation like we are in the other ones. I think some of that has just been some of the weakness or consolidation in some of the big momentum stocks. Let's discuss those. Although I do like that we are in the upper part, look where the breakdown took place. I think a lot of this is just people getting their money back who had been long up here, and they're just, oh, please get me back, to where I was, and I'll never do it again type of talk. We all have been there. That's just my opinion. Look where the breakdown took place here, where the breakdown took place here. I just think it's some responsive sellers there. Nothing too out of control. Let's talk about the 800-pound gorilla in the room, the Apple. There was some major shenanigans that took place on Friday, and I really think that there needs to be some type of an investigation. It's really, really shady. All right, so I had talked about Apple being the most bullish I've been in a while down here. I talked about starting to book some profits up against trend. You got a mild pullback. You basically, I said, as long as we hold the 107.31 and the 109.14, this area, I think it's okay. We pushed back up. You had poor highs here. 2 days, really, it was looking of consolidation. And then late on Friday, you had this news breaking from the Nikkei, which I think was like 2 in the morning there. And it was that Apple suppliers, that basically that Apple could miss the quarter. And why did this happen? If you looked at the open interest in the calls for Apple, all of the major volume was 110 plus. I can't even tell you how many people got fudged majorly. This is, there's a term I used, I don't want to say it, but effery, bad, this was bad. It was very obvious to me what happened. I think everyone was buzzing about this, that basically market makers orchestrated this kind of run. And back in the day when there used to be what's known as bucket shops, there was a bucket shop drive. Too many longs, they would put up a job to take the market down. This to me looks like a put-up job, a stick-up job to take the market down, to fudge all of those 110-plus call buyers. So that is really what I make of this. That being said, you now have some poor highs. There could be a few days of pullback. My favorite play, everyone knows this, and I talk about this quite regularly, is the shake and bake. I would love to see this stock have a very nasty few days, maybe coinciding with some kind of broader market pullback. I don't know. You can see we basically broke trend here. Probably you'll get a little bit of relief because some of this selling I think was really BS, but you ran a lot of stops. Look at this. You had the breakout day. Anything below 110.80, you really had to be out. Anything below that, this was the day that broke trend, took out the 200 MA, and you broke it. So you have a lot of momentum people who probably got flushed on Friday. That being said, same kind of rules. Anything above 109.14 to me is still okay. You could even use this consolidation range. Often when you're above a range, you come middle range. That's basically where we are. This was the gap and go day. Anything above 110.42 still kind of okay. Anything below 108.60 starts getting squeamish. I'm going to stick to that story. Like I said, I would love some type of a sell-off to come back into like this area to get the shake and bake, shake out all these people, and then kind of bake it back to the long side. I don't think too many people are expecting much out of this quarter. It might be a little iffy. I think a lot of people are waiting for the stock to kind of dump on this quarter to get back in if they miss this run. I don't necessarily know if they'll get the opportunity, but it could happen. That would be an ideal scenario for me, actually. Anyway, that being said, if you can get above all of these highs now, these 112s, I think that you'll see a quite dramatic move up higher. Let's use this range now as the guide. Anything above 112.30, bullish. Anything below 109.73, 109s really gets a little bit more iffy. So that's the story with Apple. This kind of shenanigans happened in Facebook as well this week. A lot of shady dealings going on here. This day there was a report that Facebook basically, again, might miss the quarter. I forget what the exact BS story was, but by the end of the day, the close, they basically took back and said that the story was not true. You had a pullback here. I had talked about this. Here you go. Look at this. It's weird. Sometimes I show the progression line up in 118s. This is really the true progression line in the 116s. I talked a lot of people would be worried about a double top. You're getting the pullback, the 50 MA. It held beautifully. 20 MA resisted, as did trend. You got this crazy, like, flash crash kind of day. So I'm going to tell you this. As long as we're above the 50, you've got to think the bias is still bullish. But for me, I would like to use this day, this kind of flash crash day range as the guide. Anything above 112.65 to me is bullish. I think you'll see, excuse me, a move and above 112.65, I think gets you to the all-time highs and probably new all-time highs. Anything in here I really kind of want to not be so much a part of, particularly if it's below 110.65, which was the top of this consolidation range. You can see we've closed a little bit below there. Here we closed a little above. Here a little bit below. I don't really want to be playing long so much below there, but anything below 106.52 now, to me, would be a little bit too much. I think you would easily see the 104s and maybe even a move closer back to 100. We'll see how that plays out. But obviously, again, another shake and bake scenario. I would love weakness into the quarter. The IV in Facebook has been so low for so long that it's just been like unplayable. You can't really sell puts in there because there's no juice. So for me, the weakness here is just jacking up puts that I want to sell. A lot of people are starting to get more bearish. I did a survey. Everyone still thought that Facebook would be higher on earnings, so I guess the sentiment hasn't eroded enough. But a few more days down into here, I guess that would change. We'd set up for a lovely shake and bake scenario. Amazon, I think I've been speaking plain English in this one, although you might not know it from some of the questions I get on the stream. I've said that anything above this breakout here of 585 is a long. You had the breakout, chop consolidation, moving higher. This just feels like it wants to go back up and fill some of these gaps. I would say anything below 119.45 starts getting a little bit more iffy again, but as long as you're above it, I think you could see the 635s, maybe even the channel high here, back back up to the 648, 650, maybe even close the gap to 675. They have earnings coming up, so if this runs too hard into earnings, the play might be to be long before earnings. But if there's a big, like a shake and bake in this, like there's a move up and then a pullback, you could have a long situation on your hands. So I'm gonna want to reserve my earnings ideas on this until then. But as of now, stock looks like it still wants to go higher to my eye. Netflix. All right, so let's not BS each other here. This stock has been really, really dicey. I talked about a double top here. I was pilloried for that, but I was right. You had a move below here. You never got the move down to 70 or trend, which I thought we would see, so I can't say that I was 100% right. I was right about this, but I wasn't necessarily right about the move completely lower. I still might be at some later point, but as of now, the stock is getting back above downtrend, consolidating. This, to me, this day here, was what my buddy Peter affectionately refers to as a seller shut-off pattern. You have multiple days of consolidation. This was a bit of a look below here, right to the 20, and close all the way above the range high, gap and go. Anything as long as we hold this 110.23, I would say you probably want to be more long than short. This could probably rally a little bit more. We do have earnings coming up. I always get a little bit iffy when you've had these big moves up, moves down, and then like these kind of grinds higher. So I am thinking that this could actually be a short for earnings. I may live to regret that. Just in my experience, when you've had these big run-ups and these nasty pullbacks and then kind of grinds back higher, they wind up having big down moves again. So I'm just a little bit cautious with Netflix. I probably won't do too much ahead of the number. Netflix tends to move a lot on earnings. I'm bullish on the stock longer term, don't get me wrong, but you've had a big run up into it. It wouldn't hurt to book some profits. If you want to play it short, define your risk is my opinion. Google. I've talked about this, that I like to play the extremes, long on the channel lows and then short near the channel highs. I have said, though, anything above 752.05, I would rather be long than short. That has been correct. So we have earnings coming up. I really would rather wait. I'd rather be that kind of second mouse. But Google looks okay to my eye at the moment. Chipotle. So this stock was starting to look kind of weird. You had these double bottoms here, multiple bottoms here, and then a break below, a retest above, and then a sell-off to new lows. I talked about this day. This, actually, I think it was in the, I forget which video, I was talking about this on Periscope, that a move above the 2-day high here would be a long, and it did it in a professional gap type of fashion. Look at this. Down, down, down. Shock and awe, gap up, but not only a gap up above downtrend, back up over these lows. So my opinion here was that the stock was a long, and then the next day it went higher. I don't know what's going to happen for earnings. I know that there are a lot of, someone was saying based on Foursquare data that the stock is like they're tracking 30% or below comps. I really have no idea, but I do know that there could be a squeeze into the number, and as long as you are above this high of day here, the 460.99, the trade is long, and are up to the 50 easily, I would think. That is my story. I am sticking to it. But, earnings are a whole other story, but I do think that you could see a squeeze further into the number. Tesla. I think I was pretty clear. I spoke pretty plain English about booking profits above 265. There was a pretty decent pullback. I had said once again you were a long way from Kansas here because the fibs were so much lower. The stock has been holding in fairly well, that being said. We all know that the orders for the Model X have been stellar. We know they make a great product. It doesn't really matter. The story of Tesla has really very little to do with their products, although the news cycle does help them. It's a story of a poorly distributed stock, meaning a lot of institutions don't own it, high consolidated owner interest. Musk owns, between Musk and the short interest, 50% of the stock is taken up between that. You have 33% of the stock short, and then Musk owns 22 or more percent of the stock. So that's really the story there. And then high short interest, that's the story. So it would not surprise me to see Tesla run and make new all-time highs. That being said, if it runs hard ahead of the earnings still, further squeeze, which is probably likely, I'd be careful. If there's a nasty pullback ahead of the number, it'll probably be a long for earnings. Tesla tends to peak out at the end of the summer near Labor Day, I think of the horse show. Fudge, I was going to post that date. Could somebody just remind me? I'm going to write it down, actually. You know what? I'll talk about I'll post the horse show date. I know a lot of you don't know about what the horse show is. It's a Hamptons event. It's called the Hampton Classic. I go quite frequently. It's actually a lot of fun. So That's the story. That's usually when Tesla tends to peak out. Anyway, I think we covered a good amount. Maybe we'll cover Priceline. Yeah, they have earnings coming up. I think that this could have a bit of a scare at some point this summer because of the Zika virus, although you wouldn't really know it with the way the stock is performing. You had a gap, hold, and go. Anything for me above 280.97 is still a long, believe it or not. We're a little far away from there, and we're into some reference resistance. So it would be ideal for Priceline to pull back. That doesn't usually wind up being the case. You can see here there was a run up into earnings, and then you had a gap. Look at this. It's starting to look very similar. The stock is too expensive at this point. You know, it's funny. I had a big conversation with a friend of mine. She's unfortunately passed away. You probably know her, Madison, Montana. Very talented trader. She and I used to debate about which stock of these big boys would be the first one to 1,000. And my thesis back then, this is when this stock was still in the 500s, was that it would be Priceline because it's such an illiquid stock and can move so much. She had thought Google, which obviously got there. I think it was second, but my thesis was that Priceline would be. I wish they would split this stock again so us mere mortals could kind of play. It's very hard to play a stock with this much dollar value. That being said, you kind of have a neckline here. You have a bit of an inverse head and shoulders. This was a bit of a rounded bottom, an inverse head and shoulders look. I think the stock looks like it probably wants to go higher. I would prefer to buy it on some reference areas. The 200 MA here has been some key support. Moves below it have not been sustainable. I would love a bit of a pullback ahead of the print to set up that way. Anyway, that's my story. I'm sticking to it. I hope you guys enjoyed the video, had a good weekend. Please leave some comments. If you're not subscribed to my YouTube channel, just hit the subscribe button, the like button too. I always love, I always hear from people when they hate my stuff, so hearing some nice things once in a while, it makes me feel a little bit better. Anyway, follow me on Twitter at Justin Pulitzer, and we'll have a good week. This should be an eventful one, not to say the least. Anyway, have a good week, and cheers.